All right, we're back. This is the rundown. My name is Andrew Kuhn, Focus Compounding on air live with Mr. Vetla Forslad, all the way from Norway. Vetla, how's it going
All the way
today?
from Norway. I'm good. It's sunny yet again, as you can see in my reflection. So I'm great. How are you?
Yeah, I'm doing well. It's sunny here as well. What time is it in Norway? I should look this up
It's
beforehand.
You should, but it's
But
6 p.m.
I like to give context to the listeners. You know, we want to go
Yeah,
to Norway, so it's 6 p.m.
it's 6 p.m. It's sunny. It's very windy today,
Yeah.
but it's very nice out.
Did you
Very
have a
nice
good
out.
day? What'd you do today?
I just read mostly. I had my exams coming up, and I had a coffee with a friend in Oslo. So I
Nice.
just chilled and read and had a good time. How about you?
Wonderful. What did I do? So what time is it right now? It is 10:45. So I went back to the gym for the first time in a very long
Oh
time.
wow, is that legal?
Texas is starting to open back up. It is legal.
Wow.
They ask that you clean off everything, obviously, and
Mm-hmm.
you are very respectful of that. But first time, I guess, lifting in 2 months. So that was interesting, feeling a little sore, but it
Nice.
felt good to be back in there. So I'm really happy about it. Really
Yeah.
happy about it. So we have a lot of things that we want to go over. The first thing that I want to talk about, Disney. And actually, see,
Disney.
I'm always forgetting. This is our handy dandy little prop right
Oh,
here.
nice.
This
Yeah.
is, we're going to Disneyland. This is special
Very
edition. We're
nice.
going to Disneyland. Do you know what? Do you get that reference?
I've been to Disneyland.
So in the
I've been
United
to,
States,
or the Disney World. I don't know.
yeah, maybe. Oh yeah, Disney World. I wrote Disneyland. See, I don't even
Yeah.
understand the
Yeah,
reference.
Disneyland is in Europe, I think. Anyways, go on.
in
Yeah.
the United States, when like they win like the Super Bowl or major sporting events, they're always like, "Oh, we're going to Disney World." It's like a massive, I guess, slogan type thing. And
Okay. I didn't know that.
I butchered it. We could cut this, but we're not going to because this is the rundown
No.
and we keep things real and we just roll with it.
We do. Very
But
nice.
they came out with earnings, and to no one's surprise, they were as bad as you would probably imagine.
Yeah.
From first glance, it looks like their revenue was 18 billion, which actually beat by 510 million. And their EPS was extremely down. They missed by about 47 cents. Not surprising there. I think we'll see more of the corona effects in their next earnings, especially because their parks were closed mainly for the whole quarter. But there's still a lot of interesting things that I saw. Shanghai, they are opening up their Disneyland within a week. They're going to have certain stipulations for people that do go to the parks, but they're starting to reopen. And the most important part of this report, I thought, one of the most important part was the growth in their Disney Plus subscribers. And if I was, a Netflix shareholder, maybe even an Amazon shareholder, I would really, look at this because obviously Disney Plus is competing with Netflix and Hulu, even though Disney also owns Hulu. But they went from 10 million subscribers in November of 2019 to 55 million subscribers.
Wow.
So that's pretty impressive, isn't it?
That's impressive. Yeah. Wow. Do you have that? Do you have Netflix Plus?
No.
Okay.
Disney Plus? No, I don't.
Yeah.
No. Do you?
No, but no, I don't think it's in Europe yet. It's just in the United States.
So
I think
so if that's true, and it's just the United States, 55 million.
Yeah.
That's pretty freaking crazy.
That's
penetration
very
rate.
solid. Yeah.
Yeah.
That's
I mean,
great. But the question is like,
350
isn't that just like it just drains cash from the actual company? I mean, Disney Plus is never going to compete with like parks or the movies or anything like that. Not in the foreseeable future.
Sure. Yeah. I don't know. That's a good question. I mean, the economics of streaming, obviously Netflix isn't the best. I do know that. I know Netflix burns a ton of cash, right? But, I mean, it's what's interesting if you think about Netflix, I almost think about them. It's almost like they're a venture capital firm where they're constantly being pitched, new ideas every single day, new show. And, it's interesting, but no, I don't have Disney Plus. I guess it's good to get some of their old content out there that they haven't been able to, and to really just compete in the streaming wars,
And I think it might be a hedge for what may come for TV studios in the future. I think that there's like a real possibility that TV studios as we know it might be erased like almost forever, that people won't have like 50 channels on their TV and TV studios won't be in Hollywood or whatever, that TV studios are more going to be like a digital company where people use data and analytics and stuff to find the best show. And Netflix has obviously been doing a great job at doing that. Now Disney is getting like their own branch in sort of the Silicon Valley world of TV and of movies. And there's also the possibility that streaming is going to, as I said, like erase the way people have produced films and movies in the past. So they obviously want to have a hedge for that in case that happens, or they're going to be left behind from Netflix, or they're going to have to produce movies for Netflix instead of for themselves.
Mm-hmm. Yeah. So I thought it was interesting. The stock is actually, I believe it's up today.
Yeah, I saw that.
So it
like
just shows how
2.5%.
much, I guess, negativity was priced in.
Yeah, but it's very strange because I saw like a research firm that came out with a report. I think that was before earnings, that believed that the park segment would lose about 65% of their profits. And that's like 25-30% of all of Disney's profits because the margins are so high.
Mm-hmm.
So, I mean, 2020 is going to be a massacre, most likely, for Disney. So I'm not sure how much Disney is down, how much the Disney stock is down from the February highs. Do you know that?
I could actually pull it up, but yeah, I mean,
Yeah.
obviously theme parks got slaughtered. I mean, do you think,
Yeah.
what's your opinion on as the economy starts to reopen,
Mm-hmm.
I guess let's call it consumer habits. I mean, do you think people will be going back to Disneyland and Disney World and everything? So they had a
No, I
high
think.
of, it looks like, sorry to cut you off. It looks like they started 2020. I'm just looking on my phone, maybe $145 a share. And now we're at $101 per share today.
Okay. Yeah. So that's a that's a big sell-off then. So
Yeah.
it's a lot is priced in most likely. But back to what you said, I think that customer behavior is going to be altered for several years. Like people, like parks are like it's like heaven for viruses. They can spread very easily there. There's a lot of people there, and I think people are definitely going to remember what this pandemic did to their daily lives. Like for a long time, this is not going to be something that people forget once the economy reopens again. So I do think that customer behavior is going to be changed, at least when it comes to flying, maybe to going to, Disneyland, Disney World. And there's also the possibility that people's ability to pay for trips to, Florida or to Disney parks is going to be hit as well, because it's not cheap to go to a Disney park at all.
Yeah, no, that is definitely true. I'll take the other side. I think, so after 9/11 and from, doing research on theme parks and stuff, after 9/11, for example, a lot of people kind of said the same thing. And then, obviously we know what happened. But, it'll be interesting. I mean, a virus is different than, terrorist attack. I think it'll be interesting. Now, Disney, to your point, it is very expensive to go there. I don't know how you go there with the family and spend less than, I don't know, $5,000, maybe even for a couple of days. I mean, you're spending a ton of money when you're going there.
Yeah.
And what's interesting too is there's actually a lot of adults that enjoy going to Disney World and stuff like that, and even drinking alcohol and kind of doing it as an adult, I've heard is fun. So I don't know. It'll be interesting.
Yeah. But like to take the other side of your other side, there's after 9/11, there was like a big shift in how you flew. Like before that, I don't know, I think you only spent like an hour on the airport, and then after that there was a lot of security. You couldn't
totally.
So people could see like tangible change. People saw that it was safer to fly airplane now. It's not like unless everyone's wearing masks and CDC patrols the streets, nothing is most likely going to change when it comes to protecting the world from a virus.
Totally. And from them reopening Shanghai, they are requiring everybody to wear a mask.
Wow.
Maybe they'll like brand it, and put like a Minnie Mouse. Maybe they'll like give them away, and brand it or something like that.
Oh yeah.
Anyways, next thing that you wanted to talk about says, our hedge fund's different? And this is an article that you had read. So maybe take the lead and tell us a little bit about that.
So this was an article by John Authors, he writes newsletters for Bloomberg, and basically what he was talking about is how the market in 2020 has been entirely driven by the FAMs, which is Facebook. What is that? Facebook, Alphabet, Apple, Microsoft, and Google.
Netflix.
Netflix. And it was like that from about like 2015 till 2018, 2019. But since like October or so, the entire market has just been dragged by these 4 or 5 groups of stocks. And that has a big consequence on stock pickers, because what hedge funds are not very cheap. You pay like at least a 2% fee just for the hedge fund to keep the lights on. And you would expect, when you pay that much money for someone to manage your money, that you would expect them to pick like obscure stocks, to pick stocks that you can't find in an S&P 500 index, or just come up with like these obscure picks with good hedges for in case there's like a big market drawdown. And but what's happened over the past 5 years, and extremely so over the past 6 months, is that it hasn't really paid off to hedge your money. It hasn't really paid off to find obscure stocks. It hasn't really paid off to find small caps, and it hasn't really paid off to short bad companies. The only thing that's really paid off is just buy an index fund or buy a tech fund or something to be exposed to the FAMs. And that way, that would be the best way, the best use of most people's money. And I feel like hedge funds are kind of getting that. In order to make money in this environment, they have to be extremely exposed to tech, and they can't really have any hedges, because then they're going to lose money in the bull market, and the bear market never comes around, ironically. So what we're seeing is that more and more hedge funds are not thinking for themselves. They're just kind of creating a portfolio that is very similar to the S&P 500. So while the returns may be very high, the alpha is not high at all, and the beta is very similar to S&P 500. So a lot of hedge fund customers are basically just paying for some sort of a tech engine or a tech vehicle that doesn't really hedge at all. So those are my thoughts. What do you think about that?
It's interesting. And this whole concept of value investing, even over this last downturn, and I've talked to Geoff about this. I was like, it didn't matter, what statistics you had to back, your story up, or if it was like low beta or overlookedness, or whatever people use to justify like their strategy, whether it's value, growth, defensive, it didn't matter. In this last downturn, everything just got slaughtered.
Yeah,
like you could throw all of it out the window. And I thought that was very interesting. And then it gets tougher when these high growth stocks bounce back faster. And then you, the value investor, you own companies that maybe did not bounce back as fast as like a Facebook or a Netflix, et cetera, one of those companies. But no, I think it all depends on what you're trying to do. I think, I think people will pay the fees if there is some sort of outperformance there. I do think individuals, they get too big. You could look at Bill Ackman, for example, when he was managing $20 billion, it was a lot harder to manage $20 billion than I don't know what he's managing now, $5, $6, $7 billion. So size obviously does hurt that. And you can even look at guys like Buffett, who is at, he has all the capital that he has to lay out. And he, said it doesn't sound like, I didn't get the impression that he thinks that Berkshire, now he always under promises, that he thinks Berkshire is going to, widely outperform the market over the next, 5-10 years. It's just very hard, and they're not getting a lot of deals, and you're seeing the size constraints right there. But I think it all depends on what you're trying to do. I do think there's opportunities if you do stay small. I mean, truly, like you think of like the sweet spot for funds to continuously perform well over time. I think it seriously is like less than $1 billion. I really do. And, and if you're able to do more interesting things, maybe take larger positions in companies and actually own, a pretty big stake in these businesses and maybe get involved in certain ways. I think people will still pay for that. Is 2 and 20 dead? Unless your name is Jim Simons, probably, I'm not sure, but I think people will still pay for it if there's that outperformance there. I mean, hedge funds in a way, it's kind of like the ultimate, I don't want to say it's instant gratification because you have lockups. For example, our fund, we have a 1-year lockup, but if you don't perform well or whatever, you're going to be out of business relatively quickly. So that's my thoughts. I do think it depends what you're trying to do. I mean, so the technical term of focused compounding fund is, yeah, we're a hedge fund, right? It's a GPLP, partnership. But the way I think about it, and I know Geoff thinks about it as well, is it's I don't want to say it's private equity, but we're able to take large stakes in businesses and truly think like business owners, almost like a holding company in a way. So, that's the way that we think about it. I mean, when Geoff comes out and says he's the most bearish he's ever been on the market in his 20 plus year of, investing, that's not him saying that we're not still buying stocks. We would not like to buy stocks. That's not him saying that we're going to go out and hedge away the risk by shorting the market or anything like that. That's his conclusion from studying a bunch of businesses on what's cheap and what's not cheap. So what's the market down on the year now at this point? I don't even know, like
like 12%.
Yeah, 12%,
something like that.
And that's nothing.
No.
I mean, that's nothing. So when he's coming out and saying that he's bearish on the market, I think he's saying, look, I'm looking at, tons of companies. A couple of weeks ago on the podcast, he said, I looked at 500 businesses over the weekend in some fashion. It's not like he's, reading every single 10K, but, spent time on it, and it doesn't look that interesting. And, disconnect between reality and what he's seeing which is why I think he drew the conclusion that he's pretty bearish. But that doesn't mean that we're not in the market for buying stocks, that we don't hedge or anything like that. But if we do, I mean, we have purchased more stocks. They're just, cheap from our definition of cheap.
Yeah.
And our definition of cheap, by the way, is a lot different than a lot of other investors' definition of cheap. I don't think Geoff will ever pay 25 or 30 times earnings for a business, even if it's growing fast. That's just
OTCM.
That's one. But other than that, like I can't see him ever buying these sort of high quality companies at higher prices that other investors will pay. I mean, there's investors that will pay 30 times EBITDA for businesses and be okay with it,
Yeah, exactly.
Geoff is a little bit more.
And I feel like that might be like your, and that,
but by the way, though, we run a portfolio that's very concentrated. If we were running a portfolio of 40 stocks or 50 stocks, maybe it'd be a little bit differently. But the way that we run it, because we can operate with this sort of holding company mindset and take bigger bets with a 10-year perspective, that's good. And it all is from the type of clients that we have as well. We don't do any active marketing for the fund other than content, which is through the podcast, writings, YouTube, etc. So what that does is that allows the right investors to select us, where they're able to think more so with that. And if you have good absolute returns as opposed to relative returns to S&P, then over time, we think you'll be okay. I kind of went on.
And I kind of think that's your advantage, because your fund is kind of similar to Buffett's partnership back in the 60s. And that's kind of how the initial hedge funds, when there was like a hedge fund boom in the 90s, that's kind of how it looked like. It kind of looked like the Buffett partnership in the way of they were very concentrated. They took like obscure picks. That's kind of what you're doing. And it should pay off. But like hedge funds today, they're like bigger. They're clumsier, and they kind of have to buy these big stocks. They only have like 2% positions, and they don't really have the flexibility that, for instance, you do and Buffett did in the 60s.
I mean, look at this. I'm not calling anybody out. I have great respect for the guy, and I've said that a zillion times. I hate to see it. I truly hate to see it. Alan Meekum, he's closing down his fund, and I've spoken to a couple of his investors, and they said he had to reach during this environment. And a lot of times when you get larger and your opportunity set diminishes, you have to reach. I mean, how many ideas has he invested in where it didn't make a lot of sense to you? There's some of them that it didn't make sense to me. This wasn't like Alan Meekum back in 2008, 2009 when he was smaller. And that's not me poking holes. I just think size really is tough. I think it really is tough. And there's people that can say to us, well, small companies stay small forever, or they're small for a reason, or blah, blah, blah. I mean, I've had so many lunatics say stuff to me. I'm like, that like you're saying that Facebook can't become undervalued or whatever. I'm not saying that. I'm just saying this is the pond that we fish in, and that's it,
Yeah.
So next on the rundown. This one is crazy, Betla. Absolutely crazy. Relates to the United States. 20 million jobs.
Oh, wow.
In April. ADP came out today. 20 million jobs lost in April. And you sent me a interesting article that was talking about these jobs that are starting to go from temporary layoff to
Yeah.
permanently laid off.
Yeah.
And
Exactly.
that's always been my fear with a lot of these furloughs and companies laying off their employees is at what point are they going to, are they going to hire everybody back? And is everything going to go back to normal?
Yeah, exactly. I mean, it seems like that's what the stock market is pricing in with the current rally here, that revenues are going to go back to like 90% of 2019 levels in like even in early 21 or something. But that's definitely not going to happen. I mean, even if we have a V-shaped recovery, even if we open up the economy in, say September or in June or July or something like that, we're still going to have a group of companies with less cash and more leverage and a smaller backlog at the end of the crisis than at the start of the crisis. So that's going to lead to like less demand for labor. There's going to be less activity in the economy. There's just going to be a smaller need for a lot of employees. So I don't really see any way where the unemployment rate could get back to like 4 or 5% in 21 or even maybe in 22. But that's not what I'm seeing reflected in the stock prices.
Yeah, I mean that's the scary part. I'm like, are all these companies going to have a V-shaped bottom in their hiring practices or their furloughs and everything, and start to hire all these individuals back? It's scary. And I mean, we just said it. The market's down 12%. That's nothing.
Yeah.
That's absolutely nothing. What are we back to?
Yeah.
2000, middle of 2019. That's
Yeah, and
absolutely nothing.
Nasdaq is down like 2% on the year or something like that. That's literally nothing. It might even be up by now. No, it's
Uber,
down 1%. Down 1%.
Yeah, it's crazy. And
Insane.
Uber, Airbnb, they're starting to lay off employees. I mean, every company is laying off employees, and it sucks, And but what does the investor do to profit from it? What do they do? Right? We've been in so much cash on the way down. I think the average across managed accounts, for example, I won't talk about the fund. Fund probably had roughly the same actually, but managed accounts were roughly 40% cash on the way down. And we put maybe 6% to work, 5% to work. So we really haven't, we bought a little bit more Virtu motors, as I said in the last podcast, and we haven't put a lot of cash to work, which I don't know. I mean, look, the Fed, they want to come up with $3 trillion more in stimulus. So that's what made the markets run a little bit more. But it's it's scary.
Yeah.
I mean, what are they going to? So they want to support the economy, but all these jobs aren't going to come back. I don't think the unemployment rate's going to go back to where it was.
No. Yeah, the economy is like this huge and big creature, and it's very hard to revive it once it's down. And now it's really down. This is like the biggest economic collapse since World War II, or maybe even the Great Depression.
Yeah, they said the worst since Great Depression, and we've erased all the jobs since the last recession.
Yeah. So I think it's a hard road. There's a long road in front of us to get it back to normal, a harder road than what the stock market seems to be pricing in. Even if, it may be possible that like the stock market is trying to just forget that 2020 happened, that they're kind of just discounting the future cash flows with the exception of 2020. It could be. I mean, banks have been doing that when it comes to like the breachments of covenants and stuff like that. But that assumes that we're going to go back to normal in 2021, which we're definitely not going to do, is my opinion at least.
Yeah. Natural gas. You said you have a couple picks. Natural gas has been on a bit of a tear. Tell me about that.
Where did it bottom up at?
So it looks like $1.51, and we're right around $2 now. It looks like yesterday it was at like $2.15. So it's been on a rip lately.
Yeah, it's been on a rip. And I've seen a lot of people talking about how oil has collapsed, but not a lot of people are talking about why that could be bullish for natural gas. Because there's a couple of reasons why there's a connect between oil's rise and natural gas's collapse over the past 5 years or so. And then again, there may be like an opposite connect between oil's collapse today and natural gas's rise in the future. Because natural gas has been in a bear market for well over a decade now, since like 2009, which is just that in itself is insane, and it's fallen further over the past few months. But it's not really fallen over the past decade because of demand, because demand has gone up by about like 30%. The problem is that supply has gone down, but no, the supply has gone up by twice that, like 60% or something. So there's been an oversupply in the market for at least 5, 6, 7 years. And here's where it gets interesting, because most of that supply growth has come from so-called associated gas. And associated gas is found by oil producers who are looking for oil, and then they produce gas by accident. So it's not produced by natural gas producers, but by oil producers looking for oil, and then they just accidentally find gas. So they don't really want the gas, they just get it and then they sell it because they're not going to get rid of it because it's worth, $2 per 1,000 cubic feet. So that's interesting right now, because most oil producers that produce associated gas are going to lose money for every barrel of oil that they're lifting from the ground. And in a normal environment, let's say, in 2014 and 2015, when oil prices collapsed back then, they just stored this oil in Cushing. But right now the storage is running out. So they'll be forced to stop production, or they'll be losing for every barrel they picked up. And once they stop producing crude oil, they're going to stop producing the associated gas that they also pull up from the ground. And according to a report that I read, that may mean that about 15 billion cubic feet of gas would be removed from the market, which would mean that we would be which would mean that there's more demand for gas than supply, which is a big twist from what the market has been like over the past 5 years. So in relation to that, I want to finally bring up two picks that I haven't looked at too much, but I've read a bit about them, and they seem interesting as a play if you do believe that the over storage in the oil market might lead to higher natural gas prices. So there's a company called CNX, and it has a very healthy balance sheet with the leverage ratio of below 2 times EBITDA. And it's trading at like 35 times 2019 earnings, which it's not a bargain. But the CEO said in the conference call, like last month, that they're forecasting a free cash flow of about $400 million in 2022, and then an average of a free cash flow of $500 million every year from 2022 till 2026.
What's the market cap?
$2 billion.
Nice. Cool.
That's very nice. That's a very high. That's a 50% free cash flow ratio if the guidance comes true, which it might not, but we'll have to see. So there's it's a stock that's worth putting on your radar if you're interested in the natural gas market. And there's a company called Cabot, which is another interesting one.
What's the ticker on that?
I think it's CAB. I'm not really sure. CAB.
Check the show notes. I'll put it in there.
Okay. Yeah. Nice. Anyways, it has the cheapest finding cost in the market. It costs them about 26 cents to find the natural gas. It's not leveraged at all. It has net cash on the balance sheet, and it has a free cash flow yield of around 8%. So even right now, it's somewhat good stock. It's a somewhat good company, and it's somewhat cheap. And the interesting part is that for every 10-cent increase in the price of natural gas, Cabot's free cash flow rises by $80 million, and the market cap is about $1.5 billion.
Wow.
So yeah, so I think that there are a lot of interesting picks in a market that looks like has been largely forgotten. And since we've been in a bear market for like 10 years now, I feel like people have forgotten to look at the upside, even if there might be some downside. But I picked some stocks that don't seem to have a lot of downside because they still make money even with natural gas prices this low, and they're not really that levered. They have a very healthy balance sheet.
I like it. It. Cool. So yeah, make sure you check the show notes for that. Obviously, we have some natural gas exposure through NACCO Industries, which reports earnings tomorrow. And if you want to listen to yours truly, I'm going to be on the conference call asking some questions. So
very nice.
Make sure you tune in for that. Well, that's been the rundown. My name is Andrew Kuhn. His name is Vetle Forsblad, all the way from Norway. We appreciate everybody tuning in. We're looking to do this twice a week now, Wednesdays and Sunday, potentially. And we're having a lot of fun doing it. So make sure you continue to tune in with us. This is the rundown. Thank you so much. Hit that subscribe button, thumbs this video up, follow both of us on Twitter, and we will see you in the next rundown.